Now we are going to see fourth question, 4A. So prepare a common size statement from the following figures extracted from the statements of profit and loss of XYZ Limited and offer your comments on its profitability position. So they have given 2 years data, that is 2021 and 22 and 22-23. So net sales and all they have given. So we need to prepare now common size statement. So common size income statement. So everything here we are going to mention in percentage. So first net sales. So based on net sales only we are going to mention. So net sales is 100%. Then less cost of goods sold. So this is 2,85,000 divided by 5,25,000. So 54% into 100. So 54.3%. Same way for 22-23. So 3,22,500 cost of goods sold divided by 6,75,000. So this is 47.8%. So gross profit. $240 divided by 525. So 45.7%. Here 350 to 500 divided by 75. So 52.2%. So everything should be divided by net sales. Less operating expenses. So 165 divided by 525 again. So we are getting 31.4%. So on for 22-23, 108 divided by 675. So 16%. So here we will be getting operating profit. So gross profit minus operating expenses, it is operating profit. Just a second, sorry, this is operating profit amount I have put it here. Operating expenses is 75,000. So I'm changing it. Forty-four 500 divided by 675 into 100. So now we are going to reduce interest and debentures. So 30,000 divided by 525 into 100. 5.7%. Here 25,500 divided by 675 into 100. So 3.7. So here we will be getting profit before taxes. So 135 divided by 525 into 100. So 25.7% and 219 divided by 675 into 100. So 32.4 percentage. So here what we need to do is we need to compare this and we have to give comment. So profit before taxes has improved, right? So compared to 21-22, this got improved. Even the gross profit got improved here 45.7 to 52.7. So profit was improved. But here what happened, COGS also declined, right? So 54.3 to 47.8 percentage. So it also declined. COGS also declined. But what happened, operating profit is not improved drastically because here your operating expenses got up. Even interest and debentures also contributed for higher PBT. So here, if you are seeing gross profit has increased to 45 to 52.2 percentage, it is around 7 percentage. It is increased. Even cost of goods sold also increased around 6 percentage, 6 to 7 percentage. But operating expenses increased. Because of this, operating profit have not increased much. So interest on So interest on debentures also contributed for your PBT increase. Because this also got reduced. So this was the comments we need to write. So now we are going to move for question number B. So for B, so T Limited provides you the following information. So number of equity shares, number of 17% preference shares, retained earnings, number of 10.5% debentures, 10% long-term loan they have given. So current market price of the company's equity shares is 30. Expected dividend per share for the year is 1.2, which is expected to grow at 5%. So flotation cost on issue of new equity share is expected to be 5 rupees per share. So preference shares of the company which are redeemable at par after 5 years are currently selling at 90 rupees per preference shares. So debentures of the company which are redeemable at 10% premium. So we are going to redeemable the debentures at premium. So that is 10% premium. Or after 5 years are currently quoted at 90 rupees per debenture. Corporate tax rate is 20%. Calculate the average weighted average cost of capital. So we need to calculate WACC using book value weights as well as market value weights. So first, for WACC, we need to calculate cost of equity shares, that is KE, cost of preference shares, then debentures, and for long-term loan, we need to calculate. So first, I'm going to calculate KE. So we need to calculate KE first. So how we are going to calculate KE? So formula for KE is D1, that is dividend divided by P0 minus F plus G. So F here is, I'm referring flotation cost. So D1 in this question, it is 1.2. P0 is market price, that is 30. And F is flotation cost, which is 5. So G we have given 5%. So we need to calculate based on this. So K is equal to 1.2 divided by 30 minus 5 plus 5%, which is 0.05. Or I can keep it as 5% itself, whichever is convenient to you, you can do. So 1.2 divided by 25 plus 5%. So 1.2 divided by 25. So I will be getting 0.048. So 0.048 plus 0.05. That means we will be getting 0.098. If it is in percentage, it is 9.8%. So this is KE. So then I want to calculate cost of preference shares. So preference share capital. So that is, I'm assuming it as KP. So what is the formula for KP now? So here preference share capital is face value is 100 rupees each, but now the market is selling at 90 rupees. That is realizable value is only 90. So we are going to redeemable at par only. So redeemable value is 100 rupees only. So here we need to consider preference dividend first. So preference dividend. So preference dividend plus RV. So whenever we are having redemption in a specific period, we need to use this formula. So RV minus NP divided by N, that is number of years. So whole divided by RV plus NP. Here it is minus and here in denominator it is plus, divided by 2. So this is the formula we are going to use. So what is the amount of preference dividend? It is 17%. So 100 into always remember, we are going to pay dividend only on face value, not on market value. We don't bother market value when we are calculating dividend. So 100 into 17%, it will be 17 rupees. So what is RV? That is realizable value as market value. That is we are currently selling at 90 rupees. So RV is 90. So, sorry, RV is here redeemable at par. So it is 100. So RV is 100. But NP, that is market prices, 90. Net profits. If I am selling that, issuing my different preference share capital now, I will be getting only 90 rupees. That is net profits. So N is we are going to redeem in after 5 years. So N is 5 years. So now I'm going to substitute everything in this formula. So 17 plus RV is 100 minus 90 divided by N is 5. So again whole divided by 100 plus 90 divided by 2. So here 17 plus 10 divided by 5. Here 190 divided by 2. It will come. So 17 plus 2. Here it should be 95. So 19 divided by 95. So I will be getting 0.2. That is if it is in percentage. So 0.2 into 100. That means 20%. So now I'm going to calculate for interest for debentures. So KD I'm going to calculate, that is debentures. So here I want to consider what? Interest. So this debentures are also we are going to redeem after 5 years. So the same formula which we used for preference share capital. So same formula we are going to apply here also. Interest plus RV minus NP divided by N divided by RV plus NP divided by 2. So redeemable value. What is the redeemable value here? So we are going to redeem at 10% premium and currently quoted at 90 rupees per debentures. Okay. So here 100 rupees is there. So redeemable value, that is 100 plus 10% of 100. Right. So 10% premium, that is 100 plus 10, which is equal to 110. So NP is now currently selling at 90 rupees. This is going to redeemable after 5 years. So N is equal to 5. So I'm going to calculate interest now. So remember for interest, we need to calculate based on what? Face value. So 100 into 7.5% only we need to calculate. So 100 into 7.5%, that is 7.5. So now we need to calculate 7.5 plus RV, which is 110, minus 100. Sorry, net process it's 90. So minus 90 divided by 5, whole divided by 100 plus 90 divided by 2 here. This should be 110 by 90. So 7.5 plus 20 divided by 5, 200 divided by 2. So again 7.5 plus 4, we will 20 divided by 5, 4. So here it is 100. So 11.5 divided by 100. So if I want to get it in percentage, I want to apply 100 again. So that means I will be getting 11.5 percentage. Remember, this is before tax. Okay, KD before tax we have calculated. So what we need to calculate here, we need to calculate KD after tax, right? So KD after tax is 11.5 percentage minus 1 minus tax rate. What is that? So formula here is KD minus into 1 minus T. That is the formula here. So tax rate here is 0.2 percentage, right? So corporate tax, they have given 20 percentage, that is 0.2. So 11.5 into 1 minus 0.2, we will be getting 0.8. So I will be getting 9.2 percentage. So 11 into 0.8. So I will be getting 9.2 percentage. That is KD after tax. Then what we have, long-term loan. So 10% long-term loan we need to calculate. So KT, that is long-term loan. So it is simple. We don't have a redemption value, nothing, market value. So it is a simple calculation. Interest rate into 1 minus T. So what is interest rate? 10% here. 1 minus T. Tax rate is 0.2. So I will be getting 10 into 0.8. So I will be getting 8%. So straight away we can calculate. So for cost of retained earnings, it is assumed to be same as equity. So now I'm going to calculate weighted average cost of capital. So we have everything. So based on book value, we are going to calculate first. So weighted average cost of capital. So based on book value. Now, so first I'm going to calculate based on book value. So what is the amount of equity shares? So book value is 15 lakhs. That is 1,50,000 into 10 each. Number of shares into face value, right? Then I have preference shares. That is 20,000 into 100. That is 20 lakhs. Then retained earnings. So 5 lakhs. Then 7.5% debentures, which is 30,000 into 100 each. So 3 lakhs. Long-term loan, 10 lakhs. So 10% long-term loan interest 10 lakhs. So total we are having is so 15 lakhs plus 20 plus 5 plus 3 plus 10. So we are having so it is 30 lakhs here. Sorry, I missed 10. So I will be getting 80 lakhs. So total is 80 lakhs here. So now K is 9 point, 8%. So I can substitute whatever I am calculated. So it is 9.8%. Here it is 20%. And retained earnings same as KE, so 9.8% again. So here it is 9.2%, and this is 8%. So now I want to calculate the weighted average cost of capital. So based on 9.8 into 15 divided by 80 lakhs. So I will be getting 9.8 into 15 divided by 80 lakhs. So straight away I'm multiplying with the weightage. So 1.8375. Again here 20 into 50, this is 20 lakhs divided by 80. So 20 into 20 divided by 80. So I will be getting 5. Here 9.8 into 5 lakhs divided by 80 lakhs. So 9.8 into 5 divided by 80. So 0.6125. Then 9.2 into 30 divided by 80. 3.45. Here 8 into 10 divided by 80. So 1, it will come 1. So now I am adding up everything. So 3.45 plus 1 plus 0.6125 plus 5 plus 1.8375. So which is 11.9 percentage. So which comes to 11.9 percentage. This is based on book value. Now I want to calculate the same thing based on market value. So WACC based on market value. So for book value, I am multiplying the number of shares or debentures with face value. So for market value, I want to multiply with market value. That is the only difference here I am having. So equity share capital first. So 1,50,000 equity shares I am having at the market value of what? 30 rupees, right? So market value is 30 rupees. So I want to multiply by 30. So 1,50,000 into 30. So which comes to 45 lakhs. Here, preference share capital, that is 20,000 into preference share capital is currently trading at 90 rupees. So 20,000 into 90, 18 lakhs. Then retained earnings. So here I'm not going to consider any value because this is already included in market value of your equity share capital. So here I'm not going to calculate any value. So already included in market value of equity share capital. So this is ignored. Then debentures. So 7.5% debentures. So debentures market value is again 90. So 19 to 30,000. So 18 lakhs. Then 10%. long-term loan. So I want to consider as it is. So long-term loan is 10 lakhs. So 45 plus 18 plus 18 plus 10. So here it is 27. So plus 9. So it is 100. $27 lakhs. So it is around 1 crore we are getting. So this is my market value. So again, I want to calculate. Again, I want to calculate it weighted average cost of capital, right? So that is based on here my equity share capital is 9.8 into 45 divided by 1 crore. So I'm cancelling the zeros, that's it. So 9.8 into 45 divided by 100. So 9.8 into 45 divided by 100. So 4.41. Here 18 lakhs, right? So 20% it is. So 18. So 20% into 18 lakhs divided by 100. That is 1 crore. So 20 into 18 divided by 100. So 3.6. Here it is 0. So again, KD we have calculated 9.2. So 9.2 into 27 divided by 100. So 2.484. Then here long-term loan we have calculated 8%. That is 8 into 10 divided by 100. So 0.8. So I'm totaling everything. So 2.484 plus 0.8 plus 3.6 plus 4.41. So it is 11.294%. So here we need to remember a few things. One is preference share, retained earnings while calculated market value we have to ignore because this is already added up in equity share capital market value. So we want to ignore that. And for KD, remember always we need to consider after tax. That is after calculating KD only we need to apply tax rate.